when academics take a look at this, they say, hold on here, that's not the way we should do this. Ultimately, investors have to compare the returns in this asset class relative to alternative investments they could possibly make investments in, and to what's the risk associated with this asset class. And so, first off, these are both measures of absolute returns. We care about our relative returns. And secondly, there might be risks associated with private equity investment that wouldn't be captured by just taking a look at the absolute returns. If we think about an LBO side, the significant leverage that's required might expose the investors to, for example, more systematic risk as a consequence of those higher levels of leverage. There are also other problems with these. The IRRs have some sort of implicit assumptions that you're achieving the same returns on the investments made early as subsequent investments later on, when that's not always likely to be true, and multiples are inherently not as satisfying because they don't take into account the time span which you achieve your investment. It's the total amount of money you get relative to what you put in. So the standard that my colleagues and I, when they take a look at this, what we try to do is we use something called a public market equivalent return. Nothing rocket. It's kind of like a multiple. When we're taking a look at the money that we get as investors that comes back to us relative to the money that we put in, but we're discounting that we're discounting both the inflows and the outflows at the rate of return of the S&P. So that S&P return is going to change over time. We're discounting the inflows and outflows by that S&P return. And so the way to think about this is what would be your return relative if you have those same inflows and outflows you were able to invest in the capital markets at that time. So another way to think about this is kind of implicitly assuming that there's a beta of 1 associated with private equity. Anytime this number goes above 1, you've outperformed the S&P. If below 1, you've underperformed the S&P. So this is a reasonable metric. It solves a bunch of problems associated with IRR. It's a relative performance measure. What the weakness associated with this as a performance measure is it doesn't deal with the risk issue. Again, it assumes implicitly that everything sort of has a beta of 1. But this is sort of more industry standard. We need to do something like this, and there's a couple variants of this, and I'm going to present all the results kind of going forward on returns using this public market equivalent return index. And probably the most famous single paper in private equity by Antoinette Shore and Steve Kaplan came out with these kind of important facts. First off, using the public market equivalent, and what we see here is the public market equivalent return in buyout funds over here and in VC funds over here, all of these numbers are below 100. Which means that the public market, they're getting less than you would have got if you had invested in the equity index over time. So this is kind of like a devastating result for private equity and suggesting that private equity is unable to deliver the returns like what you would get in public equity markets. So it's nice they had a second part of the paper which says, hold on here though, if we look carefully and we turn our head sideways, we find out that there's persistence in returns. And if you're a top quartile guy, that this period, you're likely to be a top quartile next period, and those guys to live better than average returns, in fact, better than what you would get in the S&P. So the message came out to investors that really what you need to do in order to achieve success in this sector is to invest in top quartile funds.